everyone. Thanks so much for joining. My name is Denise Loria. I'm the Special Projects and Operations Manager at AFC. We're thrilled to bring you today's webinar, which is in collaboration with our legal advisory member, Oric, and we're going to be talking about digital assets, blockchain, and predictive markets. So we have a great panel lineup for you guys. I just wanted to cover a few housekeeping notes. The webinar is 1 hour and it will be recorded. So if you have to hop early, it will be posted on AFC's website tomorrow. If you guys have any questions, feel free to drop them in the chat or the Q&A feature. We're going to do our best to get to them. There's obviously a lot to cover. And most importantly, we hope you enjoyed the dialogue. So I'm going to pass it over to Dan at Oric, who's going to kick off our conversation. Enjoy, guys.
Thank you, Denise, for such a great intro. Good afternoon, everybody. Welcome. I'm Dan Ullman. I am a partner in Oric's office in DC. I'm going to start out by saying something that's unoriginal. We are at a time of unprecedented convergence in digital assets in this space. And in the last 12 months, as everyone on this call knows, the Genius Act has passed, the House has passed a version of the Clarity Act. Just 9 days ago, the SEC and the CFTC issued a wide-ranging landmark joint interpretive guidance for digital currency. Stablecoin capitalization has surpassed 315 million with 315 billion with 34 trillion in transactional volume. And today's panel, with this sort of unprecedented time, brings together perspectives from law, banking, risk and compliance, and advisory experts. And these are the exact stakeholders who are shaping and are being shaped by this transformation. We have a lot to cover today, and we're pleased to talk about it. But let's start out by having each panel introduce themselves. I'd like to start with Ignacio Sandoval, who is the co-moderator and also a partner of mine at Oric.
Thanks, Dan, and that was a great intro and a framing of sort of what we're dealing with. So yeah, I'm a partner at Oric in the DC office. My practice principally focuses on the financial markets and in particular the SEC side of the equation. So it focuses on intermediaries, products, the operational aspects of how markets or other systems work. So seeing the Clarity Act and seeing the potential for the Clarity Act and also the potential for faster settlement and more efficient movements tends to be pretty exciting for me. I tend to nerd out just because the operational aspects of the financial system have always fascinated me. Maybe we can kick it off over to Michael.
Yeah, thanks. I'm Michael, a relationship manager at Bank of North Dakota. Bank of North Dakota is the only state-owned institution in the United States, so not affiliated with the federal government in regards to FDIC insurance. We are truly owned by the state of North Dakota. All our deposits are fully backed by the state of North Dakota, and we are very unique in the market as we are a correspondent bank for our 91 financial institutions throughout the great state of North Dakota. We do a lot of correspondent services from treasury management to participated loans. So happy to be here.
Great. Ben, how about you?
Yeah, thanks. And thanks to everyone for being here and inviting us to join. Matt Blumenfeld, I help drive our digital asset efforts globally at PwC and on the advisory side in the US. So we work with clients large and small, sort of bridging the two worlds. So the way you framed it earlier, Dan, about convergence, that's absolutely what we're seeing. And so excited to be here to talk with everyone.
Thanks, Matt. And last but not least, Ben.
Sure. Name is Ben Haley. I am with StableCore. We're a software as a service company helping banks and credit unions integrate digital asset products and services to their customers. Prior to joining StableCore, I was with the Federal Deposit Insurance Corporation, or FDIC, for 15 years. The last 8 years that I was with the FDIC, I oversaw pretty much anything emerging technology or fintech. So including crypto, AI, ML, digital lending, digital deposits, bots, anything you could kind of come up with that was kind of novel and innovative. I helped lead in our Dallas region and our San Francisco region. Very interested to see where the conversation goes today. I know there's a lot of movement in space, especially with administrative changes. And Dan, great job with the introduction as well on Genius and Clarity Act. Certainly going to have movements in the space. So,
Thanks very much. And just a quick note about me. Again, I'm one of Ignacio's partners at Oric DC. Before joining Oric, I spent 16 years at the Commodity Futures Trading Commission, where I was an associate director and chief trial attorney. Here at Oric, I work on digital assets every day and prediction markets, everything from setting up designated contract markets to giving advice to emerging companies on digital currency and regulatory advice. We'd like to start out today with a point that sometimes I think is overlooked in this conversation about market evolution and use cases. And I think our first issue is going to be generational wealth transfer and customer expectations. According to my research, about $100 trillion of assets will transfer from baby boomers to Gen X, millennials, and Gen Z over the next 2 decades. And of course, as everybody knows, younger generations are digitally native and expect speed, transparency, and programmability in financial services. So turning to you, Michael, how are these demographic changes changing customer expectations about speed, transparency, and programmability, and driving adoption of digital native financial products and services?
Yeah, thanks, Dan. You know, throughout the United States, and actually throughout the entire world, right? Consumers are looking at their phones all day long to receive information, to communicate, to make transactions, and everything is much faster nowadays, right? And to your point, this great wealth transfer is happening, and it's going to sunset in 2048, and approximately $127 trillion are going to be moving hands from the baby boomers down to the Gen X and millennials. And it's no secret, right, that the Gen X and the millennials are more tech savvy than our baby boomers. So you start looking at deposits on throughout the financial institutions and looking at their core deposits, and those sitting primarily with the baby boomers. So you start looking at some of the risk out there, right? If $127 trillion are going to be moving hands, are our financial institutions across the United States, are they set up to help to meet their customers or their clients, where their clients are doing business? And if not, unfortunately, I think we're going to see a lot of those deposits, start leaving financial institutions across the United States into more tech savvy, more of these financial institutions that are leaning into modern technology, into digital assets.
Really interesting.
And I would just add to that. I think you saw some of this during the last wave of digital assets. So, call it 4 years ago. We've historically seen these cycles of 4 years, and you saw a lot of money move out of banks, deposits specifically, into some of these digital asset native institutions. I think the one thing and you didn't see that money come back. And I think that's important because that's what started to scare some of the large financial institutions. Obviously, the trust in this space was broken during that cycle, right? 2022 was a bad year for crypto, and a lot of people moved out of the space and realized that in order for this space to grow, we need to improve our risk management and take seriously what it means to mature and grow as not only an industry, but as a company. And so we've seen that happen over the last couple of years, and we're starting to see, again, that convergence that we talked about earlier. But I think this whole concept of impact to deposits, I agree with Michael. The younger generation not only wants the speed, the transparency, the lower cost, but it's also about yield. And this is why at the heart of the Clarity Act and the Genius Act is this concept of yield and rewards, depending on which side you're on. But that's why it's so important that we figure that out, because this new generation is demanding higher yield on their money, or the ability to constantly earn yield on their money. And so I think there's a lot of advantages to this technology, but also just an interesting conversation on what will happen to deposits.
Yeah, and I agree too that from the standpoint of earning yield, like it's moved from earning it on your money in a deposit account to other digital assets too, right? So whether it's Bitcoin, ETH, whatever digital asset we're talking about, but it's the idea of making money off of an asset that's essentially digital. And I think that's where it's very interesting to me that we've seen over time where it's almost like every decade there's a new technology of a payment moving something. And whether it's data, which is what I view as Bitcoin, it's moving data that does have a digital asset hooked to it. But I think we'll continuously see that evolution of payments move to where if you can't digitize the dollar, customers will find something to digitize that results in value for the end user. And creating that yield or establishing a yield proposition for someone will be very interesting to see how it plays out with the various acts that are out there.
That's really, really interesting. And also, we'll get to the Clarity Act later, but as everyone knows on this call, man, really, that's the major holdup, right?
Mhm.
And what's going to happen with the stablecoins yields. And I mean, one other point is obviously the demographics here are different than any other time, right? The baby boomers being, I mean, it's sort of a double, and it's exponential that the baby boomer generation is so much larger than the other generations in this country. And then you have these sort of tech interested younger people who want everything that you described and on their phone. So interesting moving forward. Ignacio, let me ask you in this regard, like, are there other market trends that are fueling the adoption of digital assets and other on-chain solutions?
Yeah, I would certainly say so. And I think we're seeing this more in the wealth management side as well. So I think the key here, and I think we've hit on this theme, is speed and efficiency. So, if you're chasing yield, if you're trying to get into products that are going to give you yield, we're all sort of have been accustomed to long sort of settlement cycles or long cycles in being able to move assets, right? I'm not sure when, before Zelle, I'm a big Zelle user or similar sort of product user, but ACH transactions, at least in some instances, still take a couple of days to clear, right? So that can be lost opportunity and sort of the lost ability to get assets somewhere where you're going to generate yield either quickly or for the long term, right? That's always been a bit of a hindrance. We're beginning to see this sort of efforts, at least in the institutional side, towards chasing that yield. I think in part to ensure that a lot of the money managers and family offices and other wealth managers are able to retain those assets. I think Matt sort of alluded to the fact that, if some of these banks or some of these institutions aren't up to speed on the efficiencies that digital assets and that infrastructure provides, they'll lose those assets and they won't get them back. And that's a significant concern. Same thing goes to money managers, right? You can still use different AI agentic agents and other faster rails to get things done. So that's another threat to traditional money management as sort of we've thought about it. And that's why I think you're seeing concerted efforts in tokenizing digital assets and digital securities in order to sort of keep up with what this generation or upcoming generations are going to be accustomed to.
Really interesting. Thanks for that. One thing that's sometimes hard to in this space to separate from is the wheat from the chaff. And I'm interested in the entire panel about, what is actually scaling right now in digital assets? What is the next, or right now, what is the next big thing? What is successful? Happy to hear from everybody on this issue.
Yeah, I'm happy to start, I guess. I think we're still in the early stages of this. The thing I always say to people, and now that it's baseball season, I think it's actually relevant, is we're still at the signing the lineup card stage of this all. We're not in the middle of the game. We haven't removed the starter. We haven't even thrown the first pitch. So we're still setting up that infrastructure. And so I see a lot of clients that we're talking with establishing who are they going to work with, how are they going to work with them, do I need to work with a partner, can I build it all myself? So it's really that build by rent conversation that we're starting with now, where I think you are seeing a lot of success today is on the simpler use cases. So when we're talking about stable coins, it's really about cross-border, right? The money systems across the globe are not necessarily all built the same. There's different rules and regulations across the globe. But if you go to Europe, instant payments are superior to what we have here in the US. And so when you look to move money across the globe, there's lots of challenges with that. And so this technology can help solve that. Now, are we at that stage where it's perfect? Absolutely not. And there's still things that we need to figure out. But it's a good place to start because it's easy to understand. It's easy to convince your board. And again, we spend a significant amount of time with boards still educating on what this topic is and how it's going to disrupt and why. And so picking something that's easy to understand. And on the tokenization front, tokenized money market funds, right? It's easy to understand. It's easier to implement. There's still challenges there. And Dan and Ignacio, I'm sure you guys get to see this all the time with, can I reuse that as collateral for other transactions? And I think that's where the true unlock is heading. But again, easy to understand from a use case, more easy to operationalize. And so as a starting point, I would say cross-border, even treasury management. And I think one of my fellow panelists was talking about earlier, like those are the use cases on the stablecoin front. And on the other side, tokenizing money market fund and ETF. Again, nothing surprising there, but it all starts with infrastructure and making sure when you look at the capabilities you need to act in the space, you're building from a foundational perspective so that you go with one of those and then you build on top of it. So it's a journey for sure. And again, we're just at the start.
But yeah, and I would echo that. Yeah, we're definitely seeing much more tokenized money market funds, ETFs, and treasuries as well. So I think that's also another avenue that, especially from a cash management perspective, as corporate treasury departments need to figure out how to generate yield quickly and efficiently. I think everything's going to be on the table, right, in terms of how you do that with whatever portfolio or cash equivalent portfolio you have. But I think one of the things we're still sort of thinking through is in scaling this, you need uniformity, right? So if you have competing ledgers or technologies, where we're still going to see, I think, some friction is in instances where you're trying to move assets from one platform to another, and those still may not be interchangeable. So I think that's part of the friction I think we need to see solved in the industry, at least when it comes to financial products that are tokenized like securities.
Yeah, and I think it's really just leaning into blockchain technology, right? I mean, from multiple angles, from tokenized deposits to stable coins to tokenizing equities. There's actually a company called Cattle Proof. They're putting cattle on the blockchain, and it's bringing a value add to the end user for the rancher, because you can see, or the consumer can see, when they're sitting at the table at a restaurant, they can scan a barcode, or I should say a QR code, and they can see when that cow was born, what vaccines it had, when it was fed, how it was fed, when it was fattened, slaughtered, et cetera, et cetera, et cetera. And knowing kind of, knowing how, especially the millennials of the world, the millennials and even the Gen Xers and the Gen Zs, right, are being more kind of cautious on what they're putting in their bodies for food. And it's utilizing the blockchain technology and having that traceability and that permanent ledger that's open to the public. It's just really leaning into the blockchain technology.
Yeah, and I think to add there, I like Matt's kind of analogy of a baseball game. I kind of think about it a little bit more from the standpoint that we're potentially in an unending baseball game, from the standpoint that each time a new problem is presented, a new solution is challenged. And I think of what Michael, you said it just reminds me of the amount of times I heard like, well, I don't like Bitcoin, but I'm a fan of blockchain, right? So like people are a fan of the technology, and that's why we see the development of side chains developing things like cattle or stable coins come up, or the Lightning Network to show instant settlement within the Bitcoin side of things. So to me, I think there's going to be a continuous cycle of problems being solved, and the one that stood out to me the most, and I'm going to get the scalability on that, is the idea of investment firms like Fidelity, Schwab, E-Trade integrating digital asset purchases to their consumers. So I think that was a big sticking point, at least the last few years, especially during COVID, when we see people get more involved and on day trading and that kind of thing. But there's still a market to be tapped of people who sign up for services, whether it's at a bank or credit union or a whole other industry that hasn't necessarily integrated those digital asset products yet. And to me, that's where scalability will hit. It will, I think most people who want to get crypto now can do so on Coinbase or through their brokerage. But I think a lot of the barriers to entry are like, well, I've already got 40 other accounts with 40 other vendors. Like, I'll just wait till I can get access through this vendor before I buy. So to me, I think that'll be the scalability side, is when we start to see some of these financial institution movements, as well as private equity and other firms start to kind of offer some of these products and services to existing customers.
Yeah, really interesting. So yeah, maybe scalability is going to be the main thing we look at this year too, Brett, as a theme. I will say one thing interesting is that the CFTC has allowed now digital currency to be used to margin regular futures and derivatives trades. And this week, Bank of Montreal, in fact, disclosed a press release about a relationship with CME to help fiat turn into digital currency to margin trades on the CME and ICE, or CME in particular for BMO. But it's really, that is something that it was like unthinkable 5 years ago that we'd be at that stage. So anyway, really interesting on this. Let's move into something either more or less interesting, depending on your perspective, the current political and regulatory landscape for digital currency. So obviously, we've talked about some of the market factors driving supply and demand. And let's turn to policymakers a little bit and what's going on in DC. Ignacio, we referenced before that on March 17th, the SEC and the CFTC, I think it's fair to say this is an unprecedented step, put out a 75-page release on clarifying what types of digital currency are regulated by what institution, which has obviously been a major regulatory issue the last 5 or 6 years. Can you tell us a little bit or summarize what's going on with the CFTC and the SEC?
Sure, and I think this is it's pretty exciting sort of stuff, right? Because I don't think you've seen this level of cooperation between the agencies in a really long time. If anyone is an older timer like me, it's like the Shad Johnson Accord, which actually was before my time. But yeah, I think we're beginning to see that again. And I'm cautiously optimistic that this will continue beyond these two chairmen. But I think the first major joint initiative I think that we've seen that's been produced is this interp that came out last week, about 9 days ago. It effectively created a 5-category taxonomy for digital assets, right? And so the way these were sort of baked out, it's either going to be classified as a digital commodity, so not a security, a digital collectible. So think about your meme coins or other sort of tokens you get, a digital tool. So think about it as a utility, stable coins, which are clearly not securities, as at least the way the legislation has contemplated it, and digital securities, right? Which is what the SEC was effectively using for years during the Gensler era as a catch-all for all types of assets, right? So the taxonomies are helpful in that it gives you good guideposts in designing products to figure out, should I design it in a way to definitely avoid some of these more thorny categories, right? In particular, the securities category, and to a lesser extent, the commodity category, just because there are so many landmines with having something classified as a security, as we all know from the last few years, and sort of the attendant obligations that go there. But that's not to say that we have a clear sort of cut out and that these taxonomies are, in nice, clear little buckets. The Howey test and the investment contract test, which I think we're also somewhat familiar with, given how the SEC has approached things. It still comes into play, and I think the commission, the SEC, that is, really clarified that analytical framework still applies. In terms of how you're sort of designing these things, right? So even if you design it to fit within one of the other four taxonomies, you still have to be careful to analyze it from the Howey and the investment contract perspective. And sort of the big sort of takeaways there are really, how is it marketed? And is it sort of promising some sort of return or continuing payment that can be classified as an investment, right? And so for years, I think where we saw a lot of developers working on items that could have fit within the commodity framework or the utility framework, where they tended to sort of cross the line is in the way they marketed it and the promises that were being made. I think that's still true. I think the SEC has clarified that, but at least there's some clarity with respect to the other case uses that can help folks at least design products that'll avoid the SEC's scrutiny. So that said, you're still going to have instances where some products are going to have characteristics of both securities and some of the other taxonomies. So you'll still need some guidance, either from counsel or others, to figure out where you fit. But I will note that the comment period is still open on this release. So this is really the opportunity for those folks that are either developing new products or see new products on the horizon to get their comments in and engage with the staff, because they may not have considered some new technologies, or they may not be informed yet. So I think it helps them develop or fine tune some of the taxonomies that they have sort of developed. But at a minimum, we do have some clarity on which items or which types of tokens or assets can be designed so that they fit within one of the taxonomies that avoids increased regulatory scrutiny.
Right. Really helpful. Anything else to add from the panel on the release? Have you had a chance to look at it, or has it affected anything going on where you work yet?
Yeah, I think it's. Oh, go ahead, Ben.
Yeah, definitely aware of it. I think it's interesting. I agree with Ignacio's point that the both are willing and able to work together on this. It's a good sign for the market. We're more curious on how the proposed rulemaking from the federal banking agencies are going to line up for Genius Act, specifically with stablecoins. So, but still an interesting sign whenever two agencies come out and commit to an MOU in the space, for sure.
Yeah, and I would add that OCC comment period is still open as well. And so, I think we've seen a lot of back and forth on that, especially with some of the comments coming in regarding the reserve requirements. But, I think the big sort of, the big takeaway with both the Genius Act and clarity coming through is how yield is going to be treated, especially for these stable coins, right? Because I think that's, that's a significant issue for both emerging for new participants in the system and traditional financial institutions, right? Where yield was typically, especially on deposits, was typically something that banks provided. And if yield can be earned on stablecoin, it makes you wonder, or the real concern there is what's it do to bank deposits, and I think that's something we touched on a little bit earlier, and I think that's a theme that definitely Matt sort of touched on.
Yeah, for sure. And that brings us to the Clarity Act. Just a few quick words about the Clarity Act to begin with. I think that the Clarity Act is passed the House. It's again unclear whether it's going to pass in the Senate. They're two competing bills. The stablecoin yield issue that Ignacio has just referenced is really one of the major, if not the major, holding point. It's hard to tell where they are, but every day I read in Twitter that people are feeling positively about it getting passed. But we'll see. And the CFTC's SEC release either can be an indication that they are confident it's going to get passed and they want to get ahead of what the rulemaking is going to be like under the Clarity Act, or they're worried that it's not going to get passed and they want to provide some amount of public clarity about what bucket these entities fall into. But what's interesting with the Clarity Act, if it passes, it's going to be the single most significant financial legislation since Dodd-Frank. As Ignacio is describing, it's going to impose upon every intermediary of digital currency the CFTC's regulatory scheme. It is going to open up a tremendous amount of rulemaking. Anyone who's gone through the swap dealer provisions of Dodd-Frank and how intense the rulemaking was for swap dealers will understand that this is where the rubber hits the road for these. Last, and sometimes something that's not really considered under the Commodity Exchange Act, is that it's not commodities trading and futures trading is not particularly a day trading object. Mostly because when people find out that they can lose infinity if they invest $100, it tends to take away from retail trading. However, as we all know, that digital currency is a consumer, oftentimes a consumer activity, and the Commodity Exchange Act has a private right of action. So if the Clarity Act passes, I think we can see a tremendous amount of increased litigation involving the Commodity Exchange Act and all types of intermediaries that are involved. That's a long intro to that, but I'm just wondering if the panel at all is paying attention to the Clarity Act, or what are your concerns about it? And if not, we'll just move on to another topic.
Yeah, I mean, I think if you're in this space or planning to be in this space, you have to think about the Clarity Act and all the legislation that's coming. I mean, it has been more has happened in the last year and a quarter from a legislative or regulatory standpoint on this topic than the last 10 years or 17 years of existence of the asset, right? Going back to the Bitcoin white paper. I think the point that you made that's most important is the fact that you mentioned like we don't get legislation like this very often, right? 1940 is the last time we updated our securities legislation, and so that's super important because if you want to comment and you want to have an impact on how this gets drafted, to Ignacio's point, the comment letters are open. Make sure you get your voice heard, and certainly several have, on both sides of the aisle on this topic. But it's very important that we make sure that we get this right. And that's, I think, why there's a lot of care being given to that right now. But yeah, certainly folks are waiting to get that certainty that comes with a legislation and then the interpretation of it in the proposed rules. So the proposed guidance that came from the OCC, I think it was about 2 weeks ago at this point, was very important because while it wasn't surprising so much, right? I think it was as expected. There are certain nuances to it that are important to note, some around the liquidity provisioning and the reserves that you're able to hold, and what that means for your portfolio of reserve assets. I think that's very important for firms to look at. Obviously, the yield and rewards we've talked about, and now we have new guidance coming through the Clarity Act that will shore up some of that. But from a risk management standpoint, I don't think there's anything so surprising in the proposed rules on the guidance on the OCC. And we'll see something similar from the Clarity Act when that gets drafted, and then the SEC and CFTC jointly put out the proposed rules there. So, but again, what I would focus on is this doesn't come along very often, and I lived through the Dodd-Frank and moving swaps to clearing, central clearing. That was my role before PwC. I was at the NFA helping enforce those and build the rules there. So my first foray into regulation, and can say this is a very similar to that. So certainly get your voice heard.
Great. Yeah. As of last count, the CFTC, at least it's expecting, or I've read, it could be up to 40 rules and subparts off of the Clarity Act. So be a lot of action. Let's quickly move to how institutions are engaging with digital assets. We have two experts with us right here. When we were preparing for this, it's very interested in how North Dakota is approaching digital assets with projects like the Rough Rider coin.
Yeah, thanks, Dan. So, Bank of North Dakota was founded back in 1919. And And our mission has not changed, right? We do not compete with North Dakota financial institutions. We help or cooperate with our financial institutions, and we assist in their development, right? So we're looking at blockchain technology as just the as the true current modern infrastructure for transferring money, right? So we're looking at it as a comparison to a wire and ACH. And like I mentioned, we're a correspondent bank. So we work with our consortium of 91 financial institutions, like I said, not competing, but helping our financial institutions. When our financial institutions have a better balance sheet, are posting better numbers. We as Bank of North Dakota and we as the state of North Dakota are, do better. So that's why no matter what we do as Bank of North Dakota, we're always trying to figure out a true win-win, right? For us and our financial institutions. So we announced back in Q4 with our core provider, Fiserv, to launch Rough Rider Coin in Q3 of 2026. So right now, right now we're working very heavily with Fiserv and with our internal team here at Bank of North Dakota to roll out Rough Rider Coin to our 91 financial institutions. And our first use case is bank-to-bank transactions. The consumer won't see it, right? Because it's just another payment rail. But we are actually running our stable coin on the Solana blockchain. So it's a permissioned asset on the permissionless network. And so we have permission and controls on who can mint, burn, send, hold Rough Rider Coin. And that's what's allowing us to gain a lot of comfort on this. And again, going back to the win-win, it's going to be faster for our FIs. It's going to be significantly cheaper for our FIs. And we would make the argument that it's actually going to be more secure for our FIs. I mean, when's the last time we've heard of if somebody fat fingers something? When's the last time we've heard of a financial institution getting a wire or an ACH back, right? But we're building in the guardrails to allow us to actually be able to recall, those sends if need be. And we've been receiving a lot of kudos for what we're doing, a lot of support from our financial institutions, and yeah, we're just really, really happy to be rolling this out in Q3.
Really interesting. We'll keep our eyes on it. Congratulations. It sounds like a really cool undertaking. Since we have all of you here, let's talk about risks and considerations as we sit here today. We've obviously said this is a tremendously exciting time with lots of moving parts. And a question for the panel overall. So, what are the major regulatory and compliance risks that both banks and fintechs face as we sit here today?
Yeah, I guess I could start there. I think there's a few both on the risk and the compliance side. On the compliance side first, UDAP is key, unfair and deceptive practices. So advertising these products for what they are not. Stable coins are very clear under Genius Act that they're not bank deposits. Digital assets like Bitcoin, Ether are not, insured deposits. So I think, banks have to think through the steps to make sure whenever they advertise these products on their interfaces that they're not insured. So from the compliance angle, there's some Reg E touch points as well, as far as electronic funds transfer. But mostly, I kind of view some of the services so far from a UDAP perspective. From a risk management perspective, I kind of think back to the agencies have interagency guidance, so banks do, on managing third party risk. And it's not the idea of just picking a vendor and going with them, like the Solana blockchain network or whoever you're using for a wallet service provider. I think banks have to look at each product or other vendor that's providing a service and analyze the risks related to that provider, which is fairly different than what most banks I've seen in the past do. They pick one vendor who provides one product, you do risk assessment, you're done. Here, you almost have to pick a vendor with some associated products that they're going to provide and almost risk assess each product that goes through the process. So I think it's more just taking a calculated step of performing the risk assessments. And then the last thing I would add is I know it's not like true risk framework driven, but you've got to get your whole bank or credit union up to speed on the topics. So the idea of, and I'm curious with how Michael and their institution approached it, like it's not only should happen at the board, but it's got to happen all the way down to where people feel comfortable discussing with their consumers and end users, what digital assets are, what Rough Rider will be. So it's almost creating a synergy around the product offering that I think banks may sometimes overlook.
Yeah, no, no, completely agree with you, Ben. And yeah, we have been really putting in the effort to try to educate. One of our, again, going back to our mission, one of our pillars is education. So we've done what we called the Rough Rider Roadshow, right? Going around the entire all of the major cities throughout North Dakota. And then at the same time, we hold two B3 events, Banking Beyond Boundaries events, one in the springtime and one in the fall time. And and we bring in experts, throughout the industry, depending on what our theme is. And we bring in our C-suite level individuals from our 91 financial institutions, get them underneath one roof, and just have about a two-day event, and it's all about education. Because again, it's not just going to be like a flip of a switch, right? It's not going to be like, everyone understands blockchain on day one. This is a true marathon for everyone. It's not a sprint to the finish line. It's a true marathon. And I mean, I don't care if you've been in fintech for 5 days or you've been in fintech for 10 years. You're always learning something, just because with today's day and age, things are moving so fast. It's absolutely crazy. And Ben, you talk about the regulatory and compliance risks. Completely agree with you on that. I would add on top of that, you also have reputation risk, right? So with us contemplating, back in 2025 of rolling out Rough Rider Coin. Well, we were obviously looking at our reputation risk, and we started to look at our mission. I shouldn't say we started to. We went back and looked at our mission, and we truly believe it would be not leaning into our mission or not in an alignment with our mission if we weren't going down this path, because we know where the industry is going. So with our mission since 1919, it has not changed. We need to assist and help develop our financial institutions and provide them this new blockchain infrastructure. And that's what that's what we're doing, and that's what we will roll out here in Q3. But that's I think reputation risk is a risk that some financial institutions don't always measure.
Yeah, and I'll just add too, because I'm sure Matt deals with this all the time at PwC. But the other thing that I've specifically been working on at Stablecore is it's not just a PowerPoint presentation. I know, Michael, you're dealing with that too. It's show me on the ledger, show me how this moves. it's a hands-on activity, not a sit back and receive a lecture kind of statement. So,
Absolutely.
yeah, sorry, Matt, I'm sure you've got some on this as well. So,
No, I agree with you. I think your point of it takes an entire army of at a bank or a financial institution or corporate to do this correctly is absolutely right. We've seen people bring in risk and compliance on the back end, right? The business leads with the business idea. They start building the business case. They start talking about all the growth opportunities, but they forget about legal compliance, risk, all the different functions, even IA, right? If you're at a large institution, you have a strong IA function. Like bringing them all to the table up front saves you a lot of time on the back end after you come up with the product and you're ready to launch and realize you forgot to check the boxes on, well, not check the boxes, but integrate them into the business, right? It's important, but also, the one where I think we see the biggest change for organizations is around AML, KYC, and sort of when you leave the bank, right? A lot of use cases today are between the bank's four walls or the financial institution's four walls. But when you transfer value outside of the institution, there's a lot of changes that are required from an AML, KYC, sanction screening perspective, where today we're used to doing that on the back of a transaction. And with this technology, you need to do it up front. So, Michael, to some of the things that you were talking about earlier about being able to utilize either token extensions or different functions of the blockchain networks to maybe bring some of the best of traditional finance into this technology, I think that's important as well. But yeah, it's a learning path for a lot of companies, and that's why you have folks like we have on this panel here to help guide and assist along the way.
Yeah, and we're very thankful for our partners at Fiserv because to your point, Matthew, they're bringing about 13 vendors to the table with our vendor stack, and one of those being Solana. And so yeah, we can utilize those blockchain extensions. And then one of the other primary vendors is Fireblocks, and as Matt, Fireblocks is one of the leading companies for wallet infrastructure, and it's like our vendor stack we feel very, very confident on, and we're very thankful to Fiserv for that.
Actually, one interesting point of what you just brought up, and we're seeing this as a trend as well. A lot of people are utilizing vendors now to get into the game. I think what we'll see over time, and again, I don't know how quickly this happens because my crystal ball is broken, but I do think we'll see consolidation over time because, to Ben's point, and we've seen this in real life, like real use cases here of needing to do that risk assessment. And you'll recall as part of both the proposed guidance and beyond that the OCC requires you to do those third-party risk assessments, right, as you're bringing on vendors. And it's not a simple process in many instances because a lot of companies in the space are growing with the industry. And so they're not used to the third-party risk management that large institutions sometimes require. And so it's uber important to do those because while you might not get all the answers you're expecting up front, going through that journey with them will uncover different areas that you need to risk mitigate with your own controls. But where I was going with this is I think over time we'll see a consolidation, and you might start with 5, 6 vendors today because it's very bifurcated and disjointed. But over time, I think institutions will want to own their own stack, and we'll see some of that consolidation. But certainly today, speed to market and integration and getting into the market and experimenting, again, you don't have to tackle every use case up front. I think starting small, doing one thing, getting your legs under you is just as important. And I think we spoke a little bit about this before, but from a reputational standpoint, it's almost more risky not to be involved in the space than it is to jump in some shape or form.
I actually have a bit of a curveball here. With the increasing use of AI in the operational space and the risk assessment space, what use do you guys see for AI in developing these risk parameters? For really, you're using a new technology, right, to run a risk analysis or compliance on another newish technology. I'm just wondering if you guys have run across that yet in this
Or,
space.
you know, to Matt's point, especially with the digital asset side, is, we thought it was a bigger risk of being on the sidelines than a bigger risk I guess, yeah, being on the sidelines than compared to actually getting in the game. And we know as a bank, right, that we need to mitigate risk, and we're risk managers first and foremost. And so the digital asset side is something that we can gain comfort on. We can put the proper permissions and controls on, and have some good mitigants to some of those risks. On the AI side, that's an area right now that we're treading very, very lightly on. That's we're looking at a few areas on how we can kind of expedite some processes behind the scenes, but that's definitely an area that we are not fully on board with yet.
Yeah, and I can elaborate there too, because I think, Ignacio, you brought up a decent point. There's probably some places where AI can assist in this process, whether it's develop risk assessments, review disclosures for accuracy, things of that nature. But every financial institution I've been to over the last 15 years with the FDIC, the thing that they're going to fear with adopting a technology with digital assets, at least from a banker's perspective, is that regulator question of why did you assume this within a risk assessment, or why is a statement within a disclosure? And if you don't have a human reviewing that and being like, that answer is off, like it makes no sense on what we're doing, like that's the potential of having a recommendation in your report or a matters requiring board attention going to your board that most banks will want to avoid. So while banks may be able to supplement some of the ancillary services with building out a digital asset program with AI, there's, to Matthew's point, like you got to have stakeholders across the entire bank, and replacing those with AI with this new novel approach is probably not the most prudent idea. You want to have people who could help you think through it, who've been at the bank for as long as they have. So,
Yeah, really, really interesting. Okay, it's almost time for questions, but I have a lightning round question for all of you. Both have to do with predictions, prediction markets, and what you predict the next year is going to be like for digital assets. So if you can, in 45 seconds or fewer, tell us what you think is what we're gonna talk about next year at this time. And if you can, and then maybe the answer may be nothing, tell us how prediction markets are working into your businesses as you move forward to next year. We'll start with you, Michael.
Personal viewpoint here. I think I really believe 2026, 2027 is going to be a big year for Bitcoin. I think a lot of the millennials and Gen Zers are starting to look at Bitcoin in a serious way. That the millennials and Gen Zers don't want anything to do with silver and gold. So it's in their eyes, Bitcoin is digital gold. So that's a personal viewpoint. On the business side, I've actually been utilizing the prediction markets, just looking up on the internet just to kind of see what the probability of the Clarity Act is each and every day. So that's kind of one of the fun areas I utilize the market.
Thanks for that.
Yeah, I would say just to the point about I don't even know if it's just Gen Z on Bitcoin, but Bitcoin is holding up much better than other financial assets, whether it's stocks, gold, silver, during this tumultuous time with the macro events. So I know we've all long thought of Bitcoin as the digital gold, but this is the first time where we're really seeing it sort of actually play out that way. Not necessarily a prediction, just an observation of the market right now. And again, not financial advice by any means. I think, again, we've spent the greater part of the last 5, 6, 7, 10 years talking about legislation, and we need this certainty in order to move forward, or clarity, for lack of better terms, to move forward. I think this is going to be the year of execution and seeing it really come to light. So my prediction is I guess, centered around that we'll actually see real value being driven out of the use cases that we've talked so much about. I know, based on the conversations I'm having with clients, everyone's starting to get sick of the word tokenization because we haven't seen it, mature and actually come to fruition. And I know we're here talking about stable coins, but just want to remind people that stable coins and tokenized deposits and all things are all centered around the topic of tokenization. So I think this is the year of actual action. And we're already seeing it sort of unfold. So maybe it's not bold enough.
Great
Yeah,
answer.
mine will be quick. I think we'll see a movement into continuous new digital assets into a variety of financial services, whether it's banks, credit unions, other places. But I also think that they are going to figure out this interest rate thing. And I think it's going to sit around what OCC is proposing of no interest rate yield, but you merchants being able to offer a discount to accept stable coins. So I think it'll kind of come in a different manner. So
Excellent. Ignacio, anything to add? Put you on the spot.
My prediction, pain. I don't know if anyone was Rocky 3. I think what we're seeing, especially at Oric, right, being a tech heavy firm, is the shift is moving towards an app for everything type structure. So prediction markets are part of the loop, but everything else really being housed or available through a one-stop shop. I think this generation would really sort of appreciate that, and they would rather have one or two vendors to go to rather than shifting vendors if they don't necessarily have to. My prediction is that these markets and other emerging markets are just going to be part of the suite of services that are offered through one holistic platform. We're already seeing some of that with some of the participants out there, but I think we're going to see a considerable acceleration there.
Excellent. Okay, Denise, are we still have time for a few questions?
Yeah, there are a few that came into the chat. So, one of the last ones that came in was, how do you foresee the evolving regulatory landscape impacting the development of new products in asset management, particularly when it comes to choosing between fund vehicles and tokenized wrappers? Oof.
So I
I'll
can give
start.
go ahead. No, I was gonna say I can give the non-legal opinion, but some of that is a legal question. So why don't you start and I'll follow up.
I from my perspective, it's having the tools there are going to be helpful. But I was on a panel or participant panel a while ago where sort of the takeaway there with tokenizing existing assets or new assets or things of that nature, it's really sort of what's the use case, right? What's the benefit, right? So to the extent we can tokenize more vehicles, that's great. But I think you're not going to get mass adoption, at least by the bigger financial institutions or your traditional financial managers, unless there's a significant cost saving efficiency that comes into play, right? So if you have a one-time multiple and sort of the benefit, probably won't see as much adoption. If it's 10 times, I think that's where you'll see more movement in wrapping more of these products. So, I think it's going to be a slower slog, so to speak. But I think once you see an increased case use and sort of the increased benefits, I think we'll evolve towards that becoming the standard, but I don't see it happening right off the bat. And I think Matt hit the nail on the head, right? The first pitch hasn't even been thrown here, but we're still sort of in the opening parts of whatever this is that's developing, if we're using the game analogy.
I'll just add
Awesome.
one point.
Oh, sure, go Matt.
I was just going to say, I do think that we have a demand issue here. So it hits on what Ignacio was saying, right? Seeing the true benefits of all this. There's tons of supply out there But until we can address some of the legal issues as to how this can be reused as collateral, I think that's when the true unlock happens, and we're not there yet from an operational perspective.
Yeah.
But
Yeah. Well, I think that's a great way to close out. So thank you everyone for joining, and most definitely thank you to our panelists. Really appreciate all your insight. And as a reminder, the recording will be posted on the American Fintech Council website tomorrow. So everyone enjoy the rest of your day.